Hello students, this video clip will be covering how to trade treasury bills and commercial papers with the discounting concept, And then we'll practice one of these exercises today. So, as we discussed in class, we are dealing with the money market instrument that has the maturity less than 1 year. So we need to identify how long days, which is the period. So from this period, commercial paper or this treasury bill issued by the government or the corporations sell this money market instruments already determined with the face value. The face value and the purchase price is determined when they issued. Okay. So, for the perspective of the issuer, the discounting concept starting from the face value in the future. So we now look back to the present time into the purchase price, because the face value is already determined, like face value 1 million, 1 billion, or whatever. Okay, so the purchase price is going to be lower than this face value. Then what is the difference between two? The purchase price and the face value. That is the interest, right? So the purchase price is calculated face value minus interest. This interest amount is calculated by the discount rate. So we'll calculate how to get the discount rate starting from this face value. It's always the starting point is face value when we use this discount rate. So the face value minus face value times the discount rate, the interest rate, face value times interest rate times the days divided by 365, the portion of this the investment days, okay, out of 1 year, 365 days. So we get this interest for the period. Then how do you get this discount rate for the perspective of borrower? Okay, discount rate is interest divided by face value. That is the interest for the period, for these days, times 365 divided by days. Okay, you have to keep it in mind. This is not the portion, but we want to annualize this interest rate, because this interest rate is the interest rate for the period of this investment, right? So we want to annualize 365 divided by 90 days. If this investment is 90 days, that means that 4 times from this interest rate made by this investment period, so that we can end up with this annual discount rate. Always interest rate should be presented in annual, okay? Then how do we get this interest? Face value minus purchase price. Face value minus purchase price divided by, so you need to remember this, face value. Why? This is discount. Always the starting point is the maturity, when mature, right? And then, again, 365 divided by days. So we can get this discount rate, and then we apply here, we get the purchase price as well. We have a different perspective of investment. Now, if we are investor of this treasury bill or commercial paper, now this interest is calculated by the bond equivalent yield. So the face value is calculated, purchase price plus interest. Now this is kind of compound concept. Purchase is very familiar with. Purchase price times bond equivalent yield is definitely starting from the purchase price. Why? Now we started this investor's perspective to here from the present time to the future. So interest divided by purchase price, not the face value. So we have the purchase price for the perspective of investor, and then this is the annualized the factor, and then how to calculate The interest is calculated face value minus purchase price divided by purchase price from this standpoint, start point. And then we multiply this annualized factor. Okay? So let's apply this concept into this exercise. Requirement number 1. The treasury bill is issued at discount rate 1.5%, maturity 91 days, face value or the future value is just 100 for one piece of a treasury bill, and calculate purchase price and the bond equivalent of this treasury bill for the perspective of the investor. So we also use 365 days a year convention, and then we will calculate 6 decimal places. Why? This is a huge amount of investment, usually like billions of dollars, millions of dollars of investment. So just one more decimal determines thousands or the tens of thousands, even the millions of dollars if the initial investment is like billion. Okay, now let's just get started. Purchase price is equal to face value minus interest. The purchase price is, how do we calculate it? Right, the face value minus face value, interest is calculated face value times discount rate times the period. Why? We want to calculate the purchase price at the current time starting from the face value. When you start from the face value in the future, in maturity, we need to come back to the present, so we need to use the discount rate. We need to use the discount rate, right? Here you go, the discount rate. So let's calculate how to get it. So what is the face value? 100 minus $100 face value for one piece of this treasury bill times what was the discount rate, which is given 1.5%, right? 1.5% times. Now we need to de-annualize for this investment period, 91 days divided by 365 days. So we got, okay, purchase price is definitely should be lower than $100 because this is the discounting the issuance of treasury bills. Okay, now we got it. So one piece of this treasury bill is purchased at $99.626027. Okay, bond equivalent yield is for the investor's perspective in terms of this investment rate of return, right? Investment rate of return. So how to get it? Here we go. Face value minus purchase price. That is the interest, right? Interest divided by purchase price, initial investment. That is the interest rate. But we have to annualize this interest rate made for the period, 91 days, by multiplying this annualized factor, 365 divided by 91 days, so 4 times, so that we can come up with the annual rate of the bond equivalent investment yield. Okay, so face value. Now we need the face value 100. Oh, let me make the parentheses. This is the face value, and then I don't type down because there will be more decimals, but I just want to use this, the cell, and then divided by, right, which one do we need? Purchase price. Don't put the face value there because we want to get the investment yield. The starting point should be, right, this purchase price. So I want to put this B10, the purchase price over time, and then times what do you need? Right, 365 days. So that is the annualized factor. We want to get the annual rate. So 1.505631% is now the investment yield. So, and then the discount rate. Now it's totally a different perspective. Discount rate is the rate when the government issued this treasury bill to get this the purchase price. How much purchase price you have to put into this treasury bill to get 91 days later the face value. That is the discounted concept, right? So the same way we use 100, the face value. Now the purchase price we calculated there, and then divided by not purchase price. You have to keep it in mind. Not purchase price. Again, discount rate we calculated is for the perspective of borrowers. So the face value should be applied here. Now we want to put the annualized factor because that is the interest. That is the interest rate for the period 91 days. So we need to multiply 365 days divided by 91 days, 91. So that we got this 1.5. Oh, actually we already have this 1.5 in the question, but we wanted to verify this 1.5 by this calculation process. So yeah, this is the right process. Now, if we invest in this treasury bill that will receive $10 billion in 91 days, then how much it would be the interest earned amount? We have two different ways, but the same result. Purchase amount times the bond equivalent yield times the days divided by 365, or we can put just 100 face value times discounted rate times days divided by 365, right? Or you can use just face value minus purchase price. Okay, so let's go this way. So how much is the purchase price? Now we got this number, right? Which is purchase price times how many pieces of a treasury bill to get $10 billion at maturity, right? 100 million. Ooh. Okay, so be 10 times the purchase price is 100 million, and then times, now we use this BEY, the bond equivalent yield. Okay, how much interest we'll get when we purchase this treasury bill at $99.626027. So we apply this BEY, and then number of period 91 days out of 365 days. So we got 37,397,260.27. That's why just one basis point, even 0.01 basis point, which is 0.000001% is really important. That determines a lot of money. Okay, so let me just copy this, paste, so you can see it. Or you can calculate just the face value. The face value is going to be $100 per one piece of treasury bill times how many? 100, right? 100 million. Or I want to just put this, the purchase price, the difference between the purchase price and the face value, and then you can get easily. Then you should get the same result as this calculation. Okay, so we got this interest earned amount. Again, it's very important. Why? At the end of the day, when you're working in a global company, like a big company, Google or Apple, even you are going to learn the huge multinational billion the company in the future. So you are going to learn this, run this the money market instrument like treasury bill for the safest investment for the short term. Okay. Okay. For the next part, I want you to practice yourself. I will attach the answer file. Okay. See you in the next video clip. Bye bye.